cat or dog, SUV or grocery getter, IPA or stout, sandwich triangles or squares. Choices, choices, choices. Well, I have another one for you. FHA or conventional. Hi there, it's Ben Binger here, your local home loan expert. And on this episode of Did You Know, we're going to tackle the differences between an FHA loan and a conventional one. How are they different, and which one might be the best for you? Conventional loans have long been held as the gold standard for mortgage financing. As far back as a bank was willing to lend money for a home purchase, you have conventional loans. Now, a conventional loan does require certain criteria to be met, including consistent work history, stable or improving income, and a healthy credit history and score. Conventional loans are the benchmark, the vanilla standard of home loans. Now, to look at the differences, let's take a tiny journey back to the Great Depression of the 1930s. Starting with the stock market crash on Black Tuesday, this economic event was devastating to hardworking families and individuals, similar to you and me. Crop prices fell by 60%, unemployment rose by 25%, banks became hesitant to lend out mortgage money, and the housing market just began to dry up. In 1934, as a part of the National Housing Act, the Federal Housing Administration, or FHA, was formed. The idea was for the government to create a loan program to assist borrowers that the banks were still nervous to lend money on. The way that the government insured these loans was to charge a mortgage insurance. Now, back to present day, FHA loans are still backed and guaranteed to the lender by the U.S. government. When does an FHA loan make sense? Well, perhaps if you have a credit score under 700, if you have a collection or two on your credit, if your job history is on and off, an FHA loan might be a great option for you. See, conventional loans will go down to 640, sometimes as low as 620 credit score, while FHA loans will go down even further to a 580 or at times even lower. Mortgage insurance is a requirement on all of these loan types if you have a down payment less than 20%. But conventional and FHA loans handle that MI or mortgage insurance a bit differently. For details on this, make sure to check out my episode that covers mortgage insurance. But for this episode, know that if you have a score over 720, your monthly MI will be cheaper with a conventional loan. The last difference that's worthy of noting on an FHA loan is that in addition to your monthly MI, FHA loans also have a second portion of mortgage insurance that you pay at closing. This is called your upfront mortgage insurance premium. It can be financed into the loan, but as you're comparing loan types, it's important to be aware of this. At the time of this recording, upfront MIP is 1.75% of your loan amount. So for an example, on a $250,000 loan, in addition to your down payment, your standard closing costs and fees, with an FHA loan, you will pay an additional $4,375 for your mortgage insurance upfront. The differences on FHA versus conventional loans are certainly worth weighing out as you really look at the best option for your needs, especially if you're looking at purchasing a condo. Be aware that many condo projects have not been approved by HUD or the FHA, and therefore they can only be purchased with a conventional loan. Food for thought. Hey, thanks so much for watching. If you found this information to be helpful, would you mind giving me a like or subscribe? That way you can keep getting every episode of free content delivered directly to you. Thanks again for joining me.